we're arguing is we think they've had a year of time to go ahead and kill it, but they couldn't. Instead, you've oscillated either side of 33 with two peaks at 35. So we think that the momentum picture says, no, it's too old. You're not going down. You've been going down for a year. You're ready to turn and go the other way. So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration, while silver's built this pattern on momentum that says, I haven't even begun.
Investors with an interest in silver should keep a keen eye on the situation. With the expected upturn, now may be the opportune time to invest. Silver mining and recycling have struggled to keep pace with surging industrial demand and reinvigorated investment interest. 2025 is on track to become the fifth year in a row when silver consumption outruns supplies. Clearly, 2025 could very well be a pivotal year for silver. The unfolding situation promises a thrilling ride for investors and the market. MichaelOliver is a veteran technical analyst and founder of Momentum Structural Analysis, renowned for his deep insights into financial markets. In this video, Oliver notes that gold accelerates upward while silver remains in a year-long consolidation phase. Despite sideways price action, silver is now poised for a breakout. According to Oliver, if the ratio rises back above 1.1% and eventually pushes past 1.3%, it will double silver's relative value to gold. He emphasizes that when silver breaks out, it consistently outpaces gold because silver rallies more aggressively. Historically, gold and silver deliver amplified returns during a commodity bull cycle. For instance, between 2001 and 2011, gold surged from $250 to $1,800, a seven-fold jump, while silver soared from $4 to $40, turning into a 10-bagger over the same decade. While gold is grabbing the spotlight, silver looks increasingly attractive, especially when viewed through the long-term gold-silver ratio. Looking at market fundamentals, Oliver predicts silver is primed for a major breakout, calling it the real surprise over gold. With silver at just 1% of gold's price, he notes a similar setup in 2020 led to silver doubling in 6 months. Before we dive into MichaelOliver's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think the acceleration in gold has just begun, but when you flip over to silver, they've been caught in a range with a high at 33 back in October of last year, and then a drop. And then they went to, that was May of last year and dropped. Then in October of last year, they went up to 35 and then dropped again, but it was a higher high. And then this March, they went up to 35 again and dropped and cleaned everything out. And now we're trading in the 32, 33 zone. When we we do a momentum study of that price action, which you could draw a line, you go back to May of last year, it was a year ago, 13 months ago, and draw a horizontal line across the highs that we saw back in May of last year, you're diddle-dawdling on either side of that line. So silver's really not breaking down, but it is stalled with a horizontal line going through the ink over the last year, where it goes above it and below it, above and below it. But momentum during that time, long-term momentum, has had a corrective tubular decline. Price is horizontal, basically. Momentum, it's been a parallel channel that goes back a year. And whenever momentum develops something that clear, I define it with my hands here, but it's like a channel of action on momentum, but it's very old now. It's 1 year old of this process of correcting from overbought levels. Price has only gone sideways, net on balance, while momentum has had its full correction. You break out of that channel again on momentum, and you'll do it up around the 34, 35 level using the front month silver, which is now July future. You go back up to those highs again in price, momentum will be breaking out of this massive channel. In other words, momentum will be saying, pounding the table, I'm starting again. So though it's been wild but boring for the last year on price, momentum has cooled off to the point where it's created a structure that if you break out of it, you're going to gush on the upside. And so what we're arguing is we think they've had a year of time to go ahead and kill it, but they couldn't. Instead, you've oscillated either side of 33 with two peaks at 35. So we think that the momentum picture says, no, it's too old. You're not going down. You've been going down for a year. You're ready to turn and go the other way. So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration, while silver's built this pattern on momentum that says, I haven't even begun. If you go back 50 years and look at the silver divided into the price of gold expressed as a percent, 1% is super low. So in other words, either it's going to hell and going to zero, okay, which isn't going to happen, or you're looking at a bargain, Because anytime silver gets down to 1% of the price of gold, look out the next 6 months or so and you'll see drama. In fact, this happened. It got down to 0.8% the price of gold in that COVID sell-off. And in the next 6 months, silver went off the page percent-wise. While gold had a nice, 40-50% move, silver doubled in that 6 months. There is, when you plot the spread relationship, not just the spread itself as a chart, we also run momentum of the spread. And what we're saying is that spread now has gotten bound below the 1% level, and it's just marginally below it right now as we speak. You get back above about 1.1%. That sounds trivial, but when you divide this over into gold and you see it get up, have a weekly close at 1.1% or higher, it's a boarding out of this hole, and it's saying, I'm coming out of here again. And there's another level up at 1.3% of the price of gold, but if you go through that, the lid will come off. You'll gush to 2% in a heartbeat. Well, you say 1% to 2, who cares? Well, that's a doubling of the value of silver versus gold. It's like buying something at 1 and it goes to 2, okay? So we're keenly watching the silver-gold relationship, because when that breaks out, it's never a situation that you have that gold is going down more than silver and silver's holding, and therefore silver's appreciating versus gold by not going down as much. It's always a situation where silver's going up much more than gold. So it's always bullish when silver-gold situation shifts into positive.
Technical trader MichaelOliver dismisses the focus on China's weekly gold buys, stressing that gold's rise is driven by global monetary debasement. He points to a 200% surge in global money supply over 15 years. He says this is the real force behind gold's long-term strength. Global broad money supply exceeds $100 trillion, while all mined gold's value is $12.8 trillion, requiring a 7.8x revaluation for full backing. Such a revaluation would cause massive wealth redistribution toward gold holders and dramatic price adjustments across all assets. From early January 2015 to early January 2025, the price of gold rose about 2.2 times and M2 money supply rose about 1.8 times. Gold has outpaced M2 growth, reinforcing its role as a hedge against monetary expansion and inflation. Furthermore, Oliver warns that the U.S. Treasury bond market is flashing red flags, failing to act as a haven following stock market stress. A sharp 2.5-day drop in T-bond futures points to deeper systemic issues. He views this as a sign of an emerging debt crisis that could rattle the Fed. Let's get back to the interview.
It's an interesting factor. Gold's been going up for over a decade. And now in the last year, suddenly we have this China situation where everybody has turned their focus like China's buying, China's buying, China's buying. And they try to report on it every week. How much did they buy? And in the other, we understand that just recently there was 1 million ounces sold, which isn't that much, in the bigger scheme of things, from Chinese, probably citizens, not the central bank necessarily. And everybody thinks that's all you get to watch. No, it's not. Gold moves on far broader trends in monetary degradation globally, not just U.S. money degradation, but global. I saw a report the other day that global money supply has gone up 200% over the last 15 years. Meaning the quantity of money has gone up, therefore the purchasing power, the real buying power of those money units has declined. And for the dollar, going back to the 1950s, every single decade, look at M2 and see it went from here to here, do the percent, and you'll see that it almost doubles every decade. And even more so recently because of what happened with COVID. Also, since the 2009 bear low, they did QEs. Don't be shocked if they go back and do QEs again. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points, the economic data points, because they're going to go sour big with the stock market. They follow the market. They don't lead the market down. Is the T-bond market. Something's wrong over there. Treasury bonds are normally another alternative place to put your money if the stock market is in trouble. And yet, since the stock market dropped 20% from January to April, and now has bounced, but the bonds haven't risen. They've tried repeatedly to rise in price, drop in yield. I'm talking 30-year bond futures, for example, not the short end of the market that the Fed controls, but the long end of the U.S. government debt market. It's a dog. Now, we even thought technically there was justification for T-bonds to participate with gold as an alternative to the fractured stock market. And we saw a nice surge. Back early this month, T-bonds shot up to 122 on the T-bond futures. from lows down in the mid, one teens, 115, 114, etc. So there was a big surge in price and a drop in yields, but it crashed. T-bonds in 2.5 days went from 122 in price to 111. For T-bonds, that's a crash. That kind of percent drop, especially in 2.5 trading days. And since then, they bounced back up about halfway to that 122 high. And I think the best we've seen is about 117 or so. Right now, we're trading the 115s. I think even today, we traded under 115. So the T-bonds are lame. They're not functioning as they normally do as an alternative place for money managers to shift some money to avoid risk in the stock market. What's going on there? That is of great concern to the central bank and to the government itself. So don't just look at the data points. If that T-bond market doesn't start to behave, in a healthy manner, and especially if the stock market starts to go down again and you don't see bonds go up, whoa, what's going on there? Well, we know what's going on. The big fundamental is we have a government debt crisis. The question is, when is it going to occur? And right now, T-bonds in the high 114s, you don't want to ever see the nearby future. It would be the June T-bonds right now, down to 111.5 again. We argue you close a month down there, they're going to flush them. Well, that's what will panic the Fed more than will the stock market. So watch the T-bonds and the dollar as well, which is a crippled bear market as far as we're concerned.
The outlook for silver in 2025 appears bullish, with most predictions indicating significant potential for price appreciation. Given the mounting signs across technicals, fundamentals, and macro trends, are you prepared for what could be silver's most pivotal year in over a decade? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.